Hey guys, welcome back to my channel. Today we saw another bloodbath in the market. After initial recovery, we've seen stocks dropping fast, especially tech, especially fintech, and also loss-making and higher growth stocks. So we're gonna deep dive into that, gonna see why are they dropping, what is the reason for that, and also I'm gonna show you 3 stocks that are deals in my opinion right now in this type of market. Let's get into it. If you're new here, I'm Robert, thank you for watching. And if you like this type of content, please consider subscribing and liking the video. But without further ado, let's head into it. So as we saw, the more tech related stocks, high growth, not profitable stocks that relying on a revenue multiple in terms of their valuation, but also tech stocks who are usually trading at a higher valuation compared to more traditional stocks such as in the healthcare, consumer defensive and real estate sectors have seen a huge drop, as we can see here on this map, which relates to the Fed coming out to being a bit more hawkish around their tone and how to fight and how to address the ongoing inflation that is happening in the US but also worldwide. And because interest rates have a direct impact on DCF, discounted cash flow models, the way those high growth, high flying tech stocks are valued, those valuations come down pretty quickly when the interest rate is not controlled, when inflation gets out of hand and the Fed is forced to raise interest rate higher. Higher the interest rate, the more hawkish, the more aggressive the Fed becomes, the lower the valuation will be for stocks in that moment and that those models in the calculation. So we have the Fed coming out this week with a few more minutes after their meeting. So we're gonna see, investors are waiting on that to see what's the actual outcome here, because the initial drop a few days ago was based on the comments that one of the Fed members has made that there's going to be a more aggressive fight against inflation with higher interest rates, but also with a lot of bond selling going out, reducing the Fed's balance sheet, which also has a direct impact on the market. And we recently saw something we don't really want to see. So here on that side, I've got 3 different things that we want to look at. So those 3 here, one of them is the bond yield for 5 years, one is the treasury yield curve for 10 years, and this one is for 30 years. What do you want to see in an ideal market is that the longer out you're going to invest money, the higher the interest rate, because the longer you lock it in, the higher you expecting your return to be based on the economy performing and the compound interest rate to work. So the higher you put your money, the higher the interest rate should be. But what we're seeing right now is that the price for those is 2.6 and 2.63, 2.6 for the 10 year, and for the 5 year it's 2.7. So for the shorter term you get a higher percentage than for the longer term. That's what's called an inverted yield curve, which means that investors expect short term a better return than 15 years out, which usually signals a recession incoming. And that's also one of the other factors why the market is dropping. So it all correlates obviously together, but that is basically the main concern of the investors right now, that there is an uncertainty, and the markets really don't like uncertainty. If they don't like one thing, it's uncertainty. If they can't predict what's going to be happening in the next few years, then a lot of investors pull out and then say basically the market is not investable. So that's what's happening right now. We have the inverted yield curve, which signals a recession is incoming. Basically would then also suggest stocks, earnings and everything to drop. Obviously we're still fighting for the current inflation and everything. So those are some of the concerns which led the market to drop. And but I have 3 stocks for you here today, which I think they have been also dropping hard recently, but they do have good prospects, they do have good margins and everything, and it's worth taking a look at those. So let's hop into the first one. So the first one here on the list is Twilio. So if you don't know what they're doing, they're actually everywhere but nowhere really. Like you don't really see them on a day-to-day basis, but their customers, you really will be aware of them. They have customers like Airbnb, Uber and other big companies. Their communications platform integrating their communication solution, how to deal and how to communicate with the customers via phone, text messages and so on, into the platforms of these companies, so that you on the website you can easily communicate with the customer service and the company itself. So and what they had going on for them is obviously They just released the earnings as well for Q4 and for the whole year of 2021. They had massive revenue growth happening for them in this last financial year, 61% year-over-year growth. Out of that was 42% organic, and net dollar expansion, which is one of the key metrics for this type of business. So how much dollar can you retain from your existing companies? That is sitting at 131%, which is impressive, meaning that from your existing customer base, 131% dollars will be retained, meaning those existing ones get more services, or we were able to charge them more, as this is a user-based model. So the more you use Twilio, the more you pay. So that's obviously a good sign saying that existing customers will remain with the company, but also using their services more. One of the concerns was heavy customer reliance, so on the key customers that make up a lot of revenue dollars. That's steadily been dropping to now 12%, and roughly around a 12% average for the year as well. So definitely see an improvement there from 2020, bringing those concerns a little bit down, that they rely on too little single customers. And in terms of gross profit, we can see that they've been actually steadily increasing the number of the actual gross profit number, but the gross margin also has been going up and is right around the 60% on average, I would say, for the year 2021, which is a really good gross margin. So if you can imagine that your dollar expansion sits at 130+%, your revenue growth is over 50%, and your margin sitting at 60%, that there will be a lot of dollars coming down to the bottom line once they will be able to be profitable. When that exactly is, we don't really know, but what we know is there is definitely a good business model here that has a lot of potential for free cash flow, for a lot of net profit generation in the future. So this is definitely something to be excited about. Obviously, they are still making a loss, but they're predicting for 2021 a lower loss, almost getting close to that break-even point. So it will be interesting to see if they get to that break-even point in 2022 already. But I do expect them to reach that breaking point in 2023 as it stands right now. The next one here on our list is SOFI. So we had some recent news on SOFI. What's actually been happening is that the government in the US has extended the pause on repayments for student loans. This was something that the people had asked the government for a long time now, and they have complied with it. They had put a pause on it. So SOFI came out and actually lowered the expected guidance for the year on the back of this news, because they were actually incorporating, the repayments that were about to be coming in and about to be commencing again. They had incorporated that obviously into their prediction and into their forecasted numbers. So on the back of that, we had that news coming out after the close of this market, and saw the stock dropping 5% after market, after initial drop, which is already low. As we see right now here, it's sitting at a 6.4% drop after hours on the back of those news, which obviously is not a good thing as such for the company. Thus, they have reduced their guidance, and also the market has reacted accordingly. But all it really is basically just a shift of revenue to a later point in time. If you're a long-term investor, that shouldn't really affect you at all. This should actually be seen as a buying opportunity as well, because obviously it doesn't really change their product, it doesn't change their business model, it doesn't change their outlook for the 5-year plus. So I wouldn't be concerned about that at all. I would just think that this is actually more of a buying opportunity as such. SOFI definitely has a big community behind them. Year-on-year growth of 87% of their existing members, which is outstanding. So yeah, if you look at that, 2019 Q1 was only 700. Now we're looking at almost 3.5 million members. So impressive there. And obviously that then translates to their growth in products, but also overall revenue, which, if you can see here, there's a mix between lending and financial service products. The financial service side of products has been exploding. So, the investing, the cryptocurrencies, and obviously the money managing side of things, that has really been now the focus of the company. Whereas before it was more like the lending, so student loan, personal loan, home loans. We're now actually looking for the Q4 2021 for that 450K, whereas actually personal loans, investing, and the money management, Those are the key ones for the business at the moment. Now, taking a quick look at the 2022 guidance as per the annual statement that has been released obviously before those news. We had adjusted net revenue being estimated at $1.57 billion, which was the 55% increase from 2021. So now with these news coming out, they have reduced that to $1.47 billion for revenue and for the adjusted EBITDA guidance of 100 million plus, compared to their revenue guidance of 1.57 and adjusted EBITDA of 180. Only a small reduction in overall revenue, which will still be a 50% increase year over year. So still strong revenue growth. So as I said, the student loan business is not as significant as it used to be, so that it doesn't really affect SOFI in a material way, and it's also only a shift to a later point in time, so that revenue guidance still remains pretty strong. If you think about that, we still have over 50% growth, whilst the stock falling over 6-7% aftermarket, and it had already been falling heavily over the last few months, really. So I don't think it's being reflected properly. I mean, we had a high of around $25 on the back of the bank chart news that were coming out. Now looking at, below 9, we're looking at $8.20. Super low for this. Multiples have come down aggressively. We're looking at, very small price to sales ratio now, probably around the 7 or even going into the 6 range, which is low for the type of stock, type of industry that SOFI is operating in, that fintech space, high growth, obviously over 50% growth. Definitely remains a good candidate on the list right now. Take a look at that. Let me know what you think about SOFI, but it's definitely on my list, and I have been buying up that dip. And the last one is SOFI's big brother PayPal, fintech, but very different and very mature business, high profitability, high free cash flow. But what that has in common with SOFI is really that it has been dropping like crazy over the past months, and we have really good fundamentals here still intact. We have strong apps with Venmo and with the PayPal main app. So there's still a huge business here that is intact, that producing a lot of free cash flow and net profit. So let's look into those numbers as well. If you look at the highlights from their Q4 2021 report, was that actually the TPV, the transaction processing volume, has gone up around 23% or year over year. Revenue growth has been around 20%. If you exclude eBay, so the problem with PayPal is always that they have been going away, divesting from eBay in terms of that relationship, as eBay is doing their own thing. And those numbers, the revenue growth numbers, are basically getting impacted by the decline of sales that are coming from eBay, which was quite a significant portion. But on the other side, you have the other business growing much faster actually. But still, if you look at the actual revenue growth, then you will look at a 15 to 17% versus if you were to exclude that decline from eBay, which is, just to be expected at this point, you are getting at around a 20% revenue growth. And the stock has just been hit hard even after those earnings, because they were slightly lowering their guidance. They're slightly saying, there's an uncertain time here, and we lowering our guidance a little bit, but still growing revenue to 20%. I mean, that's just impressive. For the level of maturity the company has reached already, to still be growing at that pace is very impressive. One thing to note here is that actually that headline is right. The 2020 year was a record year for PayPal. So that what that means is it's obviously nice to have a record year, but it also on the flip side makes it much harder the upcoming year then to outperform that year. So, and to, actually to be up on that note, if you compare to 2020, is impressive to be up on those active accounts, up on the revenue as we just talked about, but also up on cash flow here, $4.5 billion, 9% year-on-year increase in free cash flow, which they can obviously use to expand, to innovate, and to purchase other businesses, to acquire other businesses, to help with that revenue, top line revenue growth, which they might be lowering down if they were actually to just remain in PayPal and the Venmo apps. But that said, even Venmo is expanding much faster. PayPal obviously the PayPal app obviously reached a level of maturity. It's been around for a long time, but Venmo is still growing at a rapid pace, outgrowing now PayPal as well. And the CEO was saying that he is expecting Venmo to actually outgrow PayPal for the upcoming future, for the next 5 years, for the next foreseeable future. So that's definitely one to look into. Let me know if you're buying any of those, if you're interested as well, or let me know about any other stocks that I should be covering here on this channel. I'm always open to suggestions in the comments, and yeah, hope you enjoyed this video, and see you next time.